All right, today we're digging into an earnings report that was a real head-scratcher. You've got a company that on paper looked like it hit a home run, but then you look at the stock price and it tells a completely different story. Let's get into it.
So here's the big mystery we're trying to solve. The company posts earnings that just blow past what anyone was expecting, and the reward for that? The stock gets absolutely hammered. It makes no sense, right? So what on earth happened here?
Okay, let's start with the good news because, wow, was it good. The consensus on Wall Street was that this company was going to lose about $2.10 a share. Instead, they come out with non-GAAP earnings of a positive 92 cents. That's a swing of over $3. I mean, that is a huge, huge beat. But here's where things get wild. The market's reaction? Absolutely brutal. The stock craters 18% in after-hours trading. And that's the paradox we're here to unpack. How does a monster earnings beat lead to a double-digit collapse? To figure that out, you have to understand the two completely different stories that were being told.
So first, let's look at the story management was trying to tell. This is the bull case, right? The everything is awesome side of the coin. They laid out a really clear picture of operational wins and a bright future.
You know, the CEO pretty much said it all himself on the call. He called it a tale of two cities, which is the perfect way to frame it. He knew there were two conflicting narratives, so let's explore exactly what he meant.
So what were they pointing to? Well, a few key things. First, 4 straight quarters of growth in their core business, what they call Talent Development Solutions, or TDS for short. They also kept profit stable, with adjusted EBITDA holding at $28 million, and they even grew their margins. On top of that, they're actually generating cash, and they were really hyping up their new AI product roadmap. From their chair, the transformation plan is working.
And this chart right here, it really drives that point home. This is the engine of the company, that core TDS business, and it's been growing consistently for a full year. This is the foundation of their entire bull case argument.
Okay, but the market? Yeah, it wasn't buying it. Not at all. Investors looked right past all those positives and focused on a much darker story. They saw the bear case.
So to get why the market was so spooked, you've got to look at where the money comes from. TDS is the lion's share, almost 80%. But that other 21%, a segment they call global knowledge, or GK, well, that's where the whole story starts to fall apart.
And this is really where that tale of two cities thing comes into play. It's like for every bull point, there was a bear reality lurking right behind it. Yeah, TDS was growing, but total company revenue was actually down 3%. Why? Because that global knowledge segment just fell off a cliff, down 10%. Profits were stable, sure, but that was because demand for live training was getting weaker. And that shiny new AI roadmap? Nope. Couldn't cover up the one thing that really mattered. They cut their guidance for the rest of the year.
And this right here, this was the sentence that slammed on the brakes. When a CEO says, "We are updating our guidance," everyone's ears perk up. It's a direct signal from the company that their view of the future has changed for the worse.
Let's look at the actual numbers, because this is what matters. They lopped $20 million off the low end of their revenue forecast and $15 million off the high end. This was the massive red flag that investors just could not ignore.
All right, so let's put all the pieces together. What's our take as analysts looking at this whole mess? Well, it really just boils down to a fundamental truth about how the market works.
And it's this: the stock market doesn't really care about what you did yesterday. It is a forward-looking machine. A guidance cut is like a flashing neon sign telling investors that the road ahead is going to be a lot bumpier than they thought. And that signal tends to drown out everything else.
So what's the answer to that big question from the beginning? It's simple, really. The big earnings beat? That was the view in the rearview mirror. It was all about things that already happened. But that guidance cut? That was the view through the windshield, and the market saw trouble on the horizon. Bottom line, what's coming down the road mattered way more than what just happened.
So, if you're watching this company, what should you be looking for next? Here are the key things on our radar. We need to see if those new AI products actually get any traction. We need to watch if spending in those weaker areas bounces back. And of course, we have to keep an eye on that core TDS business to see if it stays strong. And hey, maybe they'll even do something about that struggling global knowledge unit. These are the big questions heading into next quarter.
So, putting it all together, based on that guidance cut and the clear headwinds they're facing, our rating is underperformed.
The market has spoken, and until we see a real change in these negative trends, we expect the stock is going to lag.
Okay, for our last section, let's do a little thought experiment. How would a professional trader actually play this? Let's walk through one potential idea.
The play here naturally follows that bear case. With management basically saying things will be tough for the next 3 to 6 months, a trader might initiate a short position. The bet is that the problems in that global knowledge segment aren't going away, and that could lead to another miss next quarter. You'd hold that position until it feels like all the bad news is finally priced into the stock. The big question for anyone thinking about this trade is there more pain to come?
And of course, we always have to end with this very important note. This analysis and the trade idea we just talked about are purely for educational purposes. This is not financial advice.